Yeah, well, first, it's great to be with you, Sarah. It's remarkable that the market's now only down less than 3% for the year. And regarding your question, the yield curve matters, but it's not the only thing that matters. And as we've looked at the work, historically, it does not historically has not paid to sell just because we have a yield curve inversion. It does raise the risk, but if you look historically, we've studied 7 yield curve inversions, and 12 months later, the market's been up 5 out of 7 times with an average gain of 11%. So again, it matters, Sarah, but there's a lot of other things that matter as well.
Including what the Fed does. And earlier this afternoon, I did speak with the Philadelphia Fed President Patrick Harker about the Fed's plan for rate hikes and the pace of it. I asked him whether he believes there should be a 50 or double basis point hike at the next meeting. Here's what he said about that.
Not at this point, but I wouldn't take it off the table. I am a median dot, if you look at the dot plot. So I was in for 7 25 basis point increases.
He did say that he thinks the Fed can accomplish what he calls a safe landing, but that there may be bumps along the way. He also weighed in on what he believes is the best way for the Fed to shrink its balance sheet. Listen to this.
My view on the balance sheet is we start on the process of reducing the size and then put it on autopilot, not use that as a tool of monetary policy. It's hard to do policy with 2 things moving at the same time. So let's put the balance sheet normalization on autopilot, and then we can adjust, if necessary, the Fed funds rate going forward.
Keith, how's the market going to take that? Last time Fed Chair Powell said the balance sheet shrinking was on autopilot, market didn't like it.
Yeah, I think right there, it just shows it's complicated. Historically, as we start to tie in policy early on, the markets still tend to rise. But this is one of the reasons why we thought we were going to have more significant corrections, more frequent corrections. And I think this debate of whether the Fed is moving too far or too fast will continue as a whole. So, one thing, we look back historically, Sarah, and we said, where has the Fed historically been when they started to first raise rates as far as the unemployment rate and inflation, their dual mandate? And it shows that behind the curve, right? If you look at the average unemployment rate, it's been 6%. Today, we're sub 4. And inflation's been only around 2.5% when they started to raise rates. Today, it's above 7. So they have a big task in front of them. That transition is going to create a lot of volatility. And that's why, even though we still think the primary market trend is higher, the amount of risk we're taking today is less than it would have been a year ago or 2 years ago in the early part of this market cycle.